Hi guys, it's Chad Larson with MLD Wealth. This is the 2025 market outlook. It's January 3rd. I did film this and record this yesterday, but my intern changed the password on my recording software, and as such, it didn't save. So we fired him. No, I'm just kidding. Actually had some chance to reflect on, I guess, what I spewed out and what I kind of accomplished yesterday. And then I woke up very early at about 3 o'clock this morning. I had some great insights into what I said yesterday. So hopefully this is even better. So um, always always willing to redo things and improve on them. And really, I've made a career out of asking people what they'd improve and develop and change. And here we are improving on yesterday's podcast. So let's hope this saves, because I really don't want to do it 3 times. I wanted to get into today. Really kind of set the tone of what we think about 2025. To start, investing by nature is an act of optimism. So, am I optimistic? Yeah, I have to be. There's opportunity somewhere. There's always opportunity in some corner, and sometimes it stares you right in the face, and sometimes it doesn't. But I think I want to title this, 2025 year ahead investment outlook, out of this cyclical storm and into the policy fog. A lot has happened, since I've been doing this podcast, and a lot has happened since I've, been doing this as a career, which is over 20 years now. Every time you think it's going to be different, it is, and it's not. It's tempting as we approach a new year to assume that the clock resets and we start anew. While it's true that performance is typically measured in yearly increments, it is also important to recognize that context matters. Some years like 2021 or 2023, they follow periods of falling equity prices and low valuations, and they stick out like huge opportunities, while others like 2025 come after a year of already very strong rallies. And I've been getting a lot of comments, a lot of calls, a lot of emails, asking like, when do we sell? Well, things have been so good for so long. I think things out of context. I've had clients over 20 years now, and we've had a great couple of years. That impacts their 20-year performance numbers marginally. Time in the market always outperforms timing the market. That being said, it is our job to have a view, to be tactical, to be rotational, to take profits, to reposition portfolios such that they have the highest probabilities of achieving, the rate of return required for them to meet their goals. So, what are we going to do there? So there is one word to use as investors as we enter 2025, and that is uncertainty. Of course, investing risk and uncertainty are always present within financial markets, but the breadth of uncertainty seems much larger than normal. Beyond the typical uncertainty, investors are now facing uncertainty regarding Fed policy, fiscal policy under the new administration. Trade and tariffs will dominate the news tape going forward. Business and regulatory policies, the effects of global deglobalization, and even the ongoing strength of the labor market. So I wanted to put together a quick little blurb, so I condensed some of my thoughts. And listen, I spent the better part of, I guess we're in January 3rd at 9 o'clock in the morning, the front part of this year already have spent tearing through, the economic and market outlook for, some of the sources we kind of tore through was, Vanguard's market outlook for 2025, Rebecca, KKR, Cambridge Associates, JP Morgan, Goldman Sachs, Richard Bernstein, Charles Schwab, UBS, Apollo, along with the big Canadian banks and our own internal team. And, a bit of an executive summary of, and trying to find consensus. And consensus is scary. Remember, like, greater fool's theory, states that, we will just all self-talk ourselves into a scenario and not be willing to understand what we don't. But over the past 4 years, the U.S. and global economy and markets have weathered a myriad of challenges, including the pandemic-induced distortions in manufacturing and services activity, acute supply chain and labor force disruptions due to the pandemic, with the war in Ukraine, the resulting global inflation surge, rapid and coordinated central bank policy tightening, and the impacts on real economic growth, labor markets, consumer and product prices, and earnings growth. A lot has happened, yet through these cyclical storms, the US economy has maintained an above average pace of real economic growth, and risk assets have delivered strong returns above and beyond those found in cash. As in 2024 was ending, the cyclical forces were making their way out of the economy, and profits with normalization and real economic growth, job creation, inflation pressure, and earnings growth, as well as the level of interest rates. However, the US economy's momentum is downshifting into a more normal pace. While this alone is unlikely to trigger recession, it does leave the economy more vulnerable to shocks. So call it boom time over, including those from significant policy changes that might be coming from Washington this coming year. Additionally, the strong market performance over the past 2 years has left valuations elevated in certain markets, and importantly, portfolios unbalanced by asset class, sector, style, and region. As the cyclical storm passes, but the policy fog sets in, the number one call for investors is to ensure portfolios are rebalanced after very few abnormal years. So let's talk a bit about asset allocation. It was kind of something, we tease and pick on the 60-40 portfolio many times in past podcasts. The notion of correct portfolio construction has been challenged, and diversification has become unpopular. If you had anything other than equities, U.S. equities last year, you didn't achieve the highest rates around. So we want to have offense and we want to have defense. We want to have a goalie in the net, and we also want to have skaters on the ice. That being said, it has bode well for people that have kind of pushed all their chips into equities over the past 2 years. And this is because certain assets have outperformed as their counterparts. Obviously, stocks over bonds, growth over value, US over international. And as a result, many investors find themselves offside, overallocated to past winners and underweight laggards. When thinking about portfolio construction in 2025, we must determine what problems are we solving for. Are we looking for income, capital preservation, growth? Are we tolerant of volatility? Are we risk adverse? Is liquidity important? The answers to those questions inform asset allocation and how we construct them, and both traditional and alternative assets can play a role. How these assets will perform is tied to the macro backdrop, and here the picture is muddled. Growth remains robust on the back of strong consumption and a tight labor market. Core inflation is still somewhat firm, and the outcome of the U.S. election suggests significant policy changes might be in the pipeline. All this means that the interest rate outlook may oscillate, translating into volatility across the economy and markets. Underneath this volatility, the opportunity set is shifting. So we've spent a lot of time over the last 2 years talking about the Magnificent Seven and how big they are, et cetera, within the U.S. market. And here's some interesting information for you. Obviously, the Magnificent Seven over the past 2 years have exacerbated an already powerful period of growth outperformance, leaving investors underweight other markets. While U.S. equity portfolios seem to have equal exposure to value and growth when approached at the index level, when we analyze the underlying holdings, it's definitely an overweight to growth. Interest in foreign markets seems to have stalled. Average allocation to external of the U.S. equities is at a 12-month low. And this translates into about a 20% average allocation within equity portfolios to international assets. We would be even underneath that. Roughly half of what is considered diversified. These underweights are very severe. Geopolitical uncertainty, currency headwinds, and widening growth differentials can make for strong and sustained foreign market performance, make it elusive. Though multiple expansion improvement to earnings growth, coupled with a focus on long-term trends, should allow the external of the U.S. markets to compete. We've had an incredible run in the U.S. dollar, and that's bode very well for client portfolios. And now we're starting to look at, will the dollar weaken? Vis-a-vis Canada, there's time on that trade, but within the dollar basket of trades, we are looking internationally at bolstering and building on that position significantly. But moreover, with inflation easing and borrow costs following, U.S. earnings growth should broaden out and will likely include value names, which is an added benefit and is also attractive to income-seeking investors, especially as bond yields continue to normalize. That said, the pendulum should not swing too far. Large cap U.S. growth names, including the Magnificent Seven, still have strong secular tailwinds behind them. In other words, portfolios should be balanced. For alternatives, the outcome-oriented approach towards portfolio construction is particularly relevant. Obviously, last year we launched the Alterna Private Income portfolio. We kind of skated to where the puck was going with each major component: credit, commodity, hedge fund, real asset infrastructure, private capital, solving for one of more of the problems within general portfolio construction. This will be particularly true going forward, with stretched valuations challenging future returns, income opportunities fading as rates fall, and stock bond correlations remaining positive in the absence of a recession, and will complement cyclical structural tailwinds for asset class like a normalizing rate environment. So very constructive our alternatives approach, looking more internationally across the board and making sure that we see broad market and style and geographic diversification. Within the alternatives, as you've seen, these assets will also become increasingly more approachable as technology democratizes access through lower minimums and greater liquidity. And so for this reason, the traditional stock bond framework of a 60-40 may be reformed into one that includes permanently alternative assets. Think of a 50-30-20 portfolio, for example, with 20% allocation to alternatives, financed to a varying degree by both stocks and bonds. Largely we have funded a lot of our as we have a private credit tilted focus within our alternative asset bucket, and we've funded that with opportunity, with liquidity from fixed income parts of the portfolio. Going forward with stretched valuations across various equity markets, we will be funding those from equity buckets and taking profits. All told, while the 60-40 portfolio may not be as relevant as it once was, this is because it has evolved, not because diversification is unnecessary. In fact, as macro forces continue to shift and a bevy of potential policy changes loom on the horizon, a well-diversified long-term portfolio will be that much more important. Investors are offside in certain key sub-asset classes, and we have to keep investors steady through turbulence and prevent them from jumping ship. For those worried that in today's world the 60-40 is dead, take comfort, as reports of its death are greatly exaggerated. The new diversified portfolio is alive and kicking. Listen, the S&P 500 in 2024 has been one of the strongest since 1928, and more strikingly, the current equity upswing began in October of 2023, driven by optimism in peak inflation and the prospect of a Fed pivot. We talked ad nauseum, and you can go back and fact check me on this, is that it's when sentiment turns. It's not when the numbers start to turn. It's the markets are forward-looking vehicles. So the markets have done incredibly well, and this spectacular return has been driven by profit growth. But just caution, around half of the equity return globally in 2024 has come from valuation expansion, driven by growing optimism and lower inflation and interest rates. This is going to be something, we have to be very cautious of. That market growth was coming from enthusiasm, not just economic growth. So navigating these risks, there are two risks in particular that we face as we approach 2025. First is that the recent wave of optimism has front-loaded returns, leaving them vulnerable to a correction. There are still many unknowns around tariff risks, for example, and the impact on global growth and inflation. While we expect a modest decline in bond yields, any further rise driven by fiscal pressures would likely tip the balance for equities, given the relatively low equity risk premiums we see. The second relates to the unusual degree of market concentration, and this is something I have talked about ad nauseum over the last little bit, is how much weight the Magnificent Seven and the largest companies in the U.S. make up of the S&P. The top 7 companies make up it's over 30% of the index. But it's interesting to think about how big of a role the U.S. plays in the world economy. The U.S. equity market is around 70% of the MSCI AC World Index, and the biggest 10 U.S. stocks account for over 20% of the entire value of a global index. Listen, history is filled with surprises no one could have seen coming, but it's also filled with so much timeless wisdom. I want to take a little bit of a break. I'm reading an incredible book that a colleague of mine sent me last year, and really talking about key lessons that remain constant and consistent. I talk a lot about behavioral finance and some of the core principles that guide our our risk-seeking behavior, that guide our protectionism, that guide our decision making, and that and really guide some of our missteps within the market. So, it's kind of telling a bit of a story is that if you traveled back in time 500 years ago or into the future 500 years from now, you'd probably be very astounded at how much technology and medicine has changed. And the geopolitical order would make no sense to you. The language and dialects might be completely foreign, but you'd still notice people falling for greed and fear, just like they do in our current world. You'd see people persuaded by risk, jealousy, tribal affiliations in ways that are very familiar to you. You'd see overconfidence and short-sightedness that remind you of people's behaviors today. You'd find people seeking the secret to a happy life and trying to find certainty when none exists in ways that are entirely relatable. When transported to an unfamiliar world, you'd spend a few minutes watching people behave and you'd finally say, I've seen this before, same as ever. So listen, change captures our attention because it's surprising and exciting, but the behaviors that never change are history's most powerful lessons because they preview what to expect in the future. Your future, everyone's future, no matter who you are, where you're from, how old you are, how much money you make, that there are timeless lessons in the human behavior that are some of the most important things you could ever learn. So we talk a little bit about risk. Risk is everything left on the table after you've thought of everything. It's a simple idea, but it's also so easy to overlook. We're very good at predicting the future, except for surprises, which tend to really be all that matters. So, taking that into the stock market, the valuation of every company is simply a number from today multiplied by an expectation and a story about tomorrow. Some companies are incredibly good at telling stories, and during some eras, investors become captivated by the wildest ideas of what the future might bring. And if you're trying to figure out where something is going next, you have to understand more than its technical possibilities. You have to understand the stories everyone tells themselves about those possibilities because it's such a big part of the forecasting equation. When it comes to forecasting, and I tear through a dozen or so 80-page long economic forecasts and try to find consensus along the board, I think what we can all agree to is to disagree. And you look at all the variables of inputs that go into that from past and then forecasting into the future and trying to extrapolate, like what a tough science. But just remember, over the last 100 years, that we're talking from the 1920s till today. If you were an economic forecaster, the 1920s were giddy. It was the roaring 20s. A lot of people have made those, correlations into the market that we're in today. The 30s were pure panic. The world was coming to an end in the 40s. The 50s, 60s, and 70s were boom to bust over and over and over again. The 80s and 90s were insanity. And the 2000s have really played out like a reality TV show. So if you'd really relied on data and logic alone to make sense of the economy, you'd have been confused for 100 years straight. Because over those 100 years, the markets have continued to march higher. So economic activity, more than anything, throughout the irrationality of human behavior and world events and geopolitics, is that time in the market does outperform timing in the market. So the concept of economic value is easy. Whatever someone wants has value, regardless of the reason, if any. So not utility, not profits, just whether people want it or not, for any reason. So much of what happens in the economy is rooted in emotions, which can at times become nearly impossible to make sense of. I read through an earnings report and investor update and research report on Tesla. They had soft numbers last quarter, and yet analysts almost uniformly increased targets to 40 times 2027's expected earnings. Like, sit with that for a moment. In the wake of a soft quarter and the stock price has gone bananas, analysts decided they didn't want to be on the wrong side they didn't want the fever of the mob, because everyone loves Tesla. Everyone loves what's been working for them, and a lot of people have made money with Tesla. So listen, to me, it's obvious the one thing you can't measure, can't predict, or can't model A spreadsheet is the powerful force, is the most powerful force in all of business and investing, just like it's the most powerful force in the military, same in politics, same in careers, same in relationships. It's just that a lot of things aren't going to compute and they're driven by emotions. The danger, one you see often in investing, is when people become obsessed with data and so confident in their models that they leave no room for error or surprise, no room for things to be crazy, dumb, unexplainable, and to remain that way for a long time. Always asking, why is this happening? And expecting there to be a rational answer. Reversion to the mean, I think, in my short 20-year career, has been one of the most dangerous traps of all. Everyone says eventually things revert to the mean. Maybe things just change, and that's something that you have to be consistent to. You have to be consistent to understand that you have to change and adapt with the times, or worse, always mistaking what happened for what you think should have happened. The ones who really thrive are those who understand the real world is a never-ending chain of absurdity, confusion, messy relationships, and imperfect people. That's something that we just have to accept. Making sense of this requires us admitting a few things. It'd be great if the world worked in a predictable, rational way, but constant uncertainty, misunderstanding, and the inability to know what people will do next is the actually only truth. The need for certainty is the greatest disease the mind faces. It's what causes us to overlook that the world is not one big spreadsheet whose outputs can be computed. We'd never get anywhere if everyone viewed the world as a clean set of rational rules to follow. And the next is accepting that what's rational to one person can be crazy to another. God bless the mavens. God bless Elon Musk. There are people in this world who have changed it because they don't think like us. Everything would compute if everyone had the same time horizon, goals, ambitions, and risk tolerances, but they don't. I saw an interesting article this morning. Elon Musk made $180 million when he was very young, and could have lived obviously an incredible life. And he took the 180 and I think he put 100 into SpaceX, 70 into Tesla, and 10 into Solar City. And years later, he was at the brink of all three companies failing and was borrowing money to pay for rent. He doubled down. And now Elon Musk is the richest man in the world with a net worth estimated over $430 billion. He's created a lot of impact. He's created a lot of jobs. He's really reshaped politics into the U.S. And taken back control of communication platforms like Twitter, that had been kind of diluted into a shadow box pulpit for the left. But listen, the next is accepting is that what was one rational to one person, it can be crazy to another. And so the idea is that, think about this: panic selling stocks after they've declined 5% is a terrible idea if you're a long-term investor, and a career imperative if you're a professional trader. There is no world in which every business or investing decision you would see other people make will align with your own hopes, dreams, and how things should be. Third is to understand the power of incentives. A financial bubble might seem irrational, but the people who work in these industries that are in bubbles, mortgage brokers in 2004, stockbrokers in 1999, make so much money from them that there's a powerful incentive to keep the music playing. They delude not only their clients, but themselves. And last is the power of stories over statistics. Just remember, it's how things resonate. I would say I tell stories for a living. Making the unrelatable relatable. I delve and I traffic in the world of ones and zeros and basis points and pips and ratios and gamma and volatility. Being able to paint pictures is an important segment. Best story always wins. It truly does. People don't care about facts. They care about their feelings. When you talk about something like housing prices in relation to median incomes are now above their historical average and typically mean revert, that is a bunch of nerd talk. It's a statistic. But when you hear Jim just made 500 grand flipping homes and can now retire early and his wife thinks he's amazing, that's a story. And it's way more persuasive in the moment. But it's hard to compute, and that's how the world works. I'll get back into kind of the end of the year outlook really quickly, but I really wanted to talk. I think a lot of people have been calling like, "Where's the correction? Where's the correction?" So it's a bit of a tangential rant that I wanted to go on. Obviously the market's been incredibly strong the last 2 years. You're like, okay, well, can it? Some people didn't think the market could go up after a good year, and it did again last year. And now they're really doubling down, saying the market can't go up again. It can't go up 3 years in a row. Well, are we investing for 3 years? Are we investing for 10 or 20 or 30 or 50 or 100 years? I have to really align that. I have an interesting debate with a great friend of mine all the time, and saying, he's always waiting for that pullback to invest. So the reality is, at some point, maybe you just trigger the market to have its correction, because you're going to be the guy that causes you're going to be the unlucky guy that accidentally picks the top of the market. But we're investing, the further you step away from the line, and if we're investing over a long period of time and we maintain ample liquidity for daily needs and lifestyle, being an investor, far exceeds the return of real cash. But just remember, what will cause the next recession? I don't know. What will cause the next market pullback? Anything. Listen, every year there's intra-market volatility. Last year was very muted. We had an 8.5% pullback mid-year. That is historically very shallow. So will we see a pullback this year? Absolutely. Will that cause people who have just been spoiled for the last 2 years with nothing but champagne and caviar to panic? Absolutely. That's why I expect the next pullback to be sharp. It'll be sharp, it'll be steep, but it'll be quick. But just remember, calm plants the seeds of crazy. Crazy doesn't mean broken. Crazy is normal. Beyond the point of crazy is even normal these days. And we talk a lot about the emotional cycle of a market, enthusiasm and despair and despondency and sadness and excitement. And it also goes in and around like our belief system. And it's a common life cycle of greed and fear. It's something I have printed on my desk that I try to look at every day as we get all these points of information. So if we're always getting the same velocity of information, what are we just not hearing? Like, are we not paying attention? But I think this really hit home for me. So the common life cycle of greed and fear goes like this. So bear with me. So first, you assume good news is permanent. Maybe the market's a little bit there right now. Then you become oblivious to bad news. Have some bad news things come out lately that we're ignoring? Maybe. Then you ignore bad news. This is where it starts to scare me. What bad news is out there that I'm completely ignoring? Then you deny bad news. Then you accept bad news. Then you assume bad news is permanent. Then you become oblivious to good news. Then you ignore good news. Then you deny good news. Then you accept good news. Then you assume good news is permanent. And we're back at where it all began. The cycle repeats. So let's dig deeper on why this cycle happens and why it always will. I think a lot of us, we try to like put all the pressure onto the Fed or the politicians or the housing market or the Wall Street or Bay Street of who causes all of this. We do. It's our emotions, it's our fear, and it's in our greeds. Listen, when you look at something, going back into the 60s, it was a period of scientific optimism. The previous 50 years prior to 1960, the world had gone from horse and buggy to rockets and from bloodletting to organ transplants. This caused a push among economists to try to eradicate the scourge of recessions. And if we could launch intercontinental ballistic missiles and walk on the moon, surely we could prevent 2/4 of negative GDP growth. But there's a gentleman, Hyman Minsky, who spent most of his career as an economist at Washington University in St. Louis and was fascinated by the boom and bust nature of the economy. He also thought the idea of eradicating recessions was nonsense and always would be, and here's why. So an economist really became a psychologist, but the seminal theory was called the financial instability hypothesis. The idea isn't very heavy on math and formulas. It describes a psychological process that basically goes like this. When economy is stable, people get very optimistic. When people get optimistic, they go into debt. When they go into debt, the economy becomes unstable. Minsky's big idea was that stability in itself was destabilizing. The lack of recession actually plants the seeds of the next recession, which is why we can never get rid of them. Over periods of prolonged prosperity, the economy transits from financial relations that make for a stable system to financial relations that make for an unstable system. A growing belief that things will be okay pushes us, like a law of physics, towards something not being okay. And this applies to so many things. So let's imagine a world in which the stock market never went down. Market stability is all but assured and stocks only go up. What would you do? You'd buy as many stocks as you possibly could. You'd mortgage your house and buy more. You'd consider selling a kidney and buy more still. That would be the reasonable thing to do. And in that process, price of stocks would get bid up. Their valuations would become even more expensive. They'd get so expensive that their future return prospects would decline close to zero. And at that very moment, the seeds of breakdown would start to sprout. The higher stock valuations become, the more sensitive markets are to being caught off guard by life's ability to surprise you in ways you never imagined. Surprise has 6 common characteristics: incomplete information, uncertainty, randomness, chance, unfortunate timing, and poor incentives. With asset prices priced high and no room for error, markets would be hanging on by a thread, crushed at the first sniff of anything less than perfection. That's something that we're thinking about right now. I think, and I'll kind of get out of storytelling mode here a little bit. A lot of this was some paraphrasing and some gleans of wisdom I've taken from this book. So reach out to me if you'd like to read it. It's a fantastic book. I've actually got it here. I'll quote it. It's by Morgan Housel. It's called Same as Ever. And it's really, so shout out to my friend Kevin who sent it to me. There's 23 little stories about things that never change. It really helped me kind of glean some insight into the behaviors and thought patterns of how I'm approaching day-to-day decisions in all aspects of my life. But again, the mere idea of stability causes smart and rational movement towards bidding asset prices up high to cause that instability. So where are we after a year of really strong equity performance? I saved myself from plopping up 100 charts, but equities in the US do look expensive. Okay, there's a lot of tailwinds, there's a lot of optimism, there's a lot of great things going, but things are starting to be priced to perfection. So as you've seen, we've already started to, recalibrate. We've moved some market weight exposure into equal weight exposure. We've increased cash in some models. We've taken on a starter position in international markets, looking for value outside of the U.S. complex. So we're not negative by any stretch of the means. And let me put this into perspective. The consensus that most aligns with my views of the market is that the market will return probably about the U.S. S&P 500 will probably, and I'm going to be wrong, but I got to put the number out. I think it's going to be a 10% year, which is going to be disappointing over the past 2 years. Markets were up almost, over 30% last year. So that'll feel like a terrible year. But if I go back to the S&P 500 return since 2004, when I started in the business, it's averaged 10.43% per year. That's assuming all dividends were reinvested. But that's incredible. That means $100 would be worth almost $800 by now. So if this year is nothing but an average year, is that a bad year? No, not at all. So we're not calling a sell. Like, we're still buyers of U.S. equities here, but I think it's going to be pretty front end loaded, and we have to be cautious. Just remember, but the common irony that I spend a lot of time thinking about is paranoia leads to success because it keeps you on your toes. But paranoia in itself is stressful. So the human experience, we abandon it quickly. Once you achieve success, you start coasting. And now you've abandoned what's made you successful and you begin to decline, which is even more stressful. It happens in business, investing, careers, relationships, all over the place. It is actually a theory called enantiodromia. And it's the idea that an excess of something always gives rise to the opposite. So are stocks overvalued? What is Bitcoin worth? How high can Tesla go? You can't answer these questions with a formula. They're driven by whatever someone else is willing to pay for them at any given moment, how they feel, what they want to believe, and how persuasive the storytellers are. And the stories change all the time. They can't be predicted any more than you can predict what kind of mood you're going to be in 3 years from now. So Where does the market top out? What will be that catalyst to cause some turbulence along the way? Um, we don't know, but that's why markets will never stay in the limits of sanity, and why they always overdose on pessimism and optimism. They just have to. So let's, trying to summarize this or give you, if you've sat with me this long, thank you. I think the first half certainty that we see in the market gives way to some second half volatility. We called this 2 years ago. It played out into the tail end of the second half. So overall, we enter 2025 anticipating that nominal growth will be stronger than investors expect, and accordingly are cyclically positioned in our equity and fixed income portfolios. Risks could increase around mid-year, and more defensive positioning might be appropriate at that point. 2025 is ripe with uncertainty, but for the time being, we're taking the over on nominal growth. However, that stronger nominal growth might be the catalyst for second market volatility, where the Fed doesn't keep cutting rates. So positioning how we're going to win this year. This is going to be the year of the alphabet. We're entering a very benign part of the cycle. Interest rate cuts that coincide with economic growth tend to be supportive for equities. Nevertheless, global equities have already risen very strongly, leaving them more vulnerable to any disappointments. Equity valuations have increased and leave little room for any valuation expansion. It's going to be the hard way. It's going to be real corporate earnings that have to drive this market higher. So we expect index returns to be driven solely by earnings growth. So we're calling for total equity returns around 10% through the end of 2025. Given higher valuations and unusually high concentration equity markets, we're really focusing on diversification to improve the risk-adjusted return. So we prefer a more eclectic mix of sectors and styles with an increased focus on alpha relative to beta. So we highlight 4 themes: market broadening opportunities, selective value, geographical diversification, and enhanced capital markets activity. I think we're going to start to see a lot of M&A this year, so there could be some great surprises. Diversify to amplify. Guys, given that broad equity valuations are full, profit growth is likely to be moderate, and markets are highly concentrated, we continue to focus on diversification and alpha generation. So broader participation. The reality for me as a PM, a portfolio manager, is that it's been particularly difficult to outperform mega cap US stocks through 2024, with only 15% of companies in the world that outperformed the Magnificent Seven. During that period of rising rates, the largest companies, often with the strongest balance sheet, disproportionately boosted returns. With the growing trend of lower interest rates, the contribution of index returns should widen. And I've talked about this before, how the market breadth should improve and has been improving. So within selective value opportunities, we like broadening exposure to growth, but also a barbell, which includes selected areas of value. And we've been talking about this. Pure growth does remain expensive. The premium paid for each unit of additional expected sales growth is higher now than we've seen on average since the global financial crisis. So people paying a lot for growth. The market is also rewarded higher versus lower revenue generating companies. So there's a skew. There's an opportunity within the value set. This raises the opportunity to find diversification through selected areas of value where companies, are raising shareholder returns. Geographical diversification, third point, to be clear, I'm very confident about the U.S. economy and like the U.S. equity market. That said, the degree of outperformance and valuation premium leaves selective opportunities for geographical diversification. We're seeing that at a regional and global perspective. You've seen that with the inclusion of international names across equity portfolios that can be driven, both by earnings per share growth rather than just multiple expansion. Is going to be important. And then I hinted at we expect capital markets activity, given the likely push towards deregulation in the US and a stronger forecasted growth. We expect increased capital markets activity, and we like to find companies that will be targets of potential M&A. So listen, high valuations, they fatten the downside of high value. They fatten the downside. High valuations reinforce the importance of following on these tail risks. U.S. equity values are now at levels that have not been exceeded since the post-war era, except in the late 90s. And so some of the recent uplift obviously comes on the expectations that the Trump administration will boost after-tax earnings. But even adjusting for this, U.S. equity valuations look historically high. Credit spreads are near their historic lows, and even those segments of the market where pricing more elevated risk premiums have compressed. So it's a little Goldilocks moment. It's a little too perfect. So, guys, we're extending duration out for cash. We're embracing credit for yield, not for the spread, and we're searching for value and geographic diversification. But remember, productivity holds the key. US productivity is surging, elevating both earnings and growth. Until this slows, we think the cycle will continue. When it does slow, however, the downturn will be faster and more significant than consensus believes. So, looking ahead, we do see more light than darkness. Hence, our call is to view the glass very half full. However, we do want to emphasize that higher valuations, more positive sentiment, and the rising estimates may lead to a year of more modest returns, especially relative to 23 and 24. Guys, that was a lot. I really hope that you enjoyed this segment. As always, I'm here, or any member of the MLD team is here to field any questions, any comments, any stories that you'd like to pass on. I'm such an feel so blessed and in such an enviable place within my career. I truly feel like the best is only in front of me. I celebrated my 20-year anniversary in partnership within this business, and feel like I've got 20 more. Still a relatively young man, 44 years old. I was very fortunate to start young and find my calling, and that passion. I have two children in high school now, one in grade 11, one in grade 10, and they talked to me about how I knew what I would want to do when I grew up, and I didn't. But I was fortunate to get this opportunity, and always had, at its core level, the curiosity around things and understanding how they worked. But really, what really drives me is my innate want to help people. And so I've honed and dedicated my life to having this skill set, to navigate financial markets, to navigate people's emotions and relationships, such that we can help guide them through what can be very confusing and very frightening. Like anything, thank you so much for the trust and opportunity to serve you and your family. Wishing you an incredible 2025. I think it's going to be a fantastic year. Not without bumps along the way, but we're prepared and the team is here. Enjoy your 2025. We'll be seeing many of you, and all the best in health and happiness. Take care.